Shaun, Dylan, thanks
What's going on, Peter?
Yeah, thanks for
Hey,
joining
Peter.
this morning to do our quick mini dive into what's happening in Queens. And we were talking about operations before we started. Dylan, why don't you start off? Collections is a big issue all over the city, right? And in Queens, some of the neighborhoods are performing differently. Tell us, what are you seeing on the ground, Dylan?
Sure. Stabilized apartments have been generally 75 to 80% March through June.
Mm-hmm.
And we've seen a major uptick in July, especially in our Jackson Heights portfolios, where we went from 60 to 75% in June and now to 90% in July. And we're expecting a little bit higher in August as the New York city has phased back in.
So do you think so we're talking about stabilized apartments here. So these are the tenants who, in general, like they stayed in the city. We're not talking about tenants who have gone to second homes or are living outside of the city. They're not the share market of the young professionals who, migrated to New York for work, and their companies haven't opened up yet. So you're talking about the residents who live in Queens, who have stayed in Queens, and that initially you saw collections go down at the beginning of the virus, but since then they've been steadily improving.
Right. These tenants historically, they don't have second homes. They don't plan to go anywhere, and their jobs are close to where they live in their neighborhoods. So,
right.
They were just waiting for the city to really open back up. And as that did, collections got better.
Right. Shaun, would you echo?
I'm experiencing the same thing. I think collections is building by building. I think it depends on the relationship that you have with the tenant. I think landlords that made a personal effort to humanize, the relationship early on fared better than others. Collections are improving across the board. Optically, that's a good thing. In free market units, obviously there's a tenant retention issue. Most owners strategically are trying to incentivize their current tenants to stay as opposed to leaving, and maybe giving that tenant a month free just to stay in the unit before they make that decision to decamp to Long Island or Midwest or wherever they came from is a good strategy to keep your rents high, keep yourself in full occupancy. Because when you really think about it, every vacancy could be 3 months of rent between month downtime, month broker fee, and the concession you're going to give anyway. So that's one strategy that's been working. The share market's been hurt, but I think that this all makes sense, right? It's the service workers, it's the bartenders, so as much of the pain that is sharply hitting that segment of the marketplace, I will also argue to the investor that's thinking long that's also the quickest sector to recover and to get rehired when this virus just disappears, which I think eventually it'll just happen with a light switch and it'll just be gone. Eventually that will happen. So
right. Well, when you were saying that, Shaun, I saw a quote from Jack Ma from Alibaba, and he said 2020 is not about 2020 is not about making a killing. It's getting through 2020 intact, and then the opportunities will come in 2021. And as we're in the back half of the year, maybe that's true. But the other aspect of this relative to collections and operations is retail, and I think the Queens retail is slightly different. So how are you seeing that also, Dylan?
Yeah, I think Queens is always unique, but retail specifically, 37th Avenue, the three buildings we have for sale there, they all have 200 feet of frontage on 37th Avenue. And generally, this is a high dense, heavily trafficked area where you have some national tenants, but mostly mom and pop. And those are the lifelines of this residentially dense area. So, you might have one vacancy that didn't, one tenant that didn't make it through this, but in general, that will be filled up pretty quickly because you're close to the subway and you have major foot traffic.
Well, if you contrast this with parts of Manhattan, where the retail is heavily dependent upon tourism, it's dependent upon commuters coming into the city, it's dependent upon all the office buildings being full, where many of those retailers are, still haven't opened. Some of them are saying they're never going to open now. You're basically drawing a distinction that the neighborhood retail that by and large encompasses most of the at the bottom of most residential buildings in Queens, kind of bypasses those obstacles, I guess. Is that what you're saying and noticing?
Right. And 80% of the people going into these locations live within a 2 to 3 block radius.
Yeah.
You also have Queens Boulevard, and you're close to the subway there. So Roosevelt Ave is also a few blocks away, and that helps second busiest subway. So,
yeah. Shaun, how are you seeing this? Like, how are you seeing buyers encounter both these issues right now?
So we've put 23 buildings in contract in between Brooklyn and Queens, which I oversee, since March 15th, and a good number of them, probably 60%, have been mixed use. So have a very big background in how investors are looking at this. I think the contrarian play that some very smart investors are making is in the food and beverage sector, with food and beverage retail rents under $10,000 a month. I think there's a big distinction between Haru at $30,000 a month in Midtown and, the corner bar restaurant in Prospect Heights or Williamsburg, where of course there's a short-term effect, but the human spirit is still there. I walk around the neighborhoods every single day. I see people outside in the mask, dining outside. If they're willing to do it with the mask on, they're going to be willing to party it up when things are back to normal. And so you have this disconnect where the cap rates, we just put 3 in under contract in Park Slope, where if things go back to normal on the retail rents, the buyer's looking at a 6% cap rate, and there's additional upside on the residential. Those trades used to be at 4.5% to 5%. So there is a bet that's being made on the recovery aspect of things. I just think you have to bifurcate the type of rent it is. There's a certain overhead that, if you're under a certain amount, you can survive. And I think that, smart investors are looking into that, and the banks are evaluating that criteria, just like they are the mom and pop retail that can't be destroyed by Amazon. That building behind Dylan, some of the retail there, this used to be, seen as a 3% cap rate value that's probably being valued at 5%, but there's an eye doctor there. There's a Taco Bell. Like, there's certain aspects of a business on a commercial corridor that are never going to be replaced, by Amazon. So I think that's, you gotta be smart about it, but that's where the opportunity is.
Yeah. Well, you're also talking about the retail. I mean, that's doing deliveries. So that's so neighborhood centric that, the residents depend on it, and that's going to be less effective. And when the rents pop, you also, when you mention those type of cap rates, interest rates are at the lowest. They're so low right now, right? And they're going to be low for the future. So that spread, not only have cap rates increased by about 200 basis points, but our loan rates have decreased by probably 100 basis points. So if you can lock in today's debt, and then the scenario that you said happened where you have that upside, those are going to be significant cash on cash plays.
This is the single type of feedback that everybody wanted for the last decade, at least that I've been working as. I want to buy a building at a cap rate that I can make money day one. Now, the only 2 factors that are prohibiting people from just jumping in are this idea of, am I catching a falling knife on rents, and the political atmosphere. But you have to know the market, and you have to make a decision based upon that. There's the rent rolls are getting marked down, and I really truly feel that sellers are accepting numbers based upon net effective rent schedules, and that's the opportunity. As things recover, you're buying on a net effective rent. You grow that back into the gross rent category through tenant retention. You're dramatically increasing your yield, and that's going to be the opportunity, probably for the next full 12 months. But if you're not in the game right now, you're probably not going to get in the game. So I'm shocked that my phone's not ringing off the charts with more buyer activity, because this is the moment that you need to be making offers.
Yeah, I agree with a lot of that. Dylan, if that's buyer's mindset, who is selling today? What's sellers' mindset today?
A lot of the sellers were the ones that were thinking about it in January and February. Maybe there were, most of our sellers today in Queens are long-term family-owned buildings, called 20 to 40 years. And
I just want to point out for everybody who's listening, as far as all the boroughs go, Queens has the lowest velocity and always has. So as far as the long-term kind of family-centric ownership, Queens probably ranks the highest in that. And so what you're saying, just matches up very well with who actually owns there.
Yeah, and you're really starting to see them come out. I think they've seen the writing on the wall from the last 5 years, and the rent regulation in 2019. And although we haven't seen a huge change in pre-COVID versus mid-COVID pricing for majority multifamily buildings, it's enough for the sellers to say, hey, I think there's opportunity to get out now. With interest rates low, and we're still getting close to pre-COVID pricing on marketing multifamily buildings, that it's an opportunity for them. And
well, as we wrap up, because you mentioned pre-COVID and post-COVID, and Shaun, we were talking about this,
or mid-COVID.
Or mid-COVID, right? But this is a question that I probably get asked the most is, how is, it's about pricing, and some of the initial thought will be, okay, well, let's just wait till the virus leaves, and then pricing will snap back to some level. What's your read on that, Shaun? Because I think it's a lot more nuanced than this is just about coronavirus.
No, I think that at the end of the day, buildings are based upon cash flows and just in earnings, just like a publicly traded company. And once the virus goes away, the rent rolls are being marked down, right? I just got the phone with an owner in Midtown that had $4,800 rents that he's renting for $2,400. So if that owner puts the building on the market next June or next July, he's not going to be able to hide from the fact that these rents are that low. Now, maybe the theory in the market is that the rents are going up right now, so I'm going to pay a lower cap rate. But I think that window is really to not focus so much on what is the cap rate, because the cap rates are not going to move that much. They're going to be between 5 and 6% in this interest rate environment. But what rent roll are you buying a 5 to 6% cap rate on? So if you're not in the market paying close attention to where rents were and where they are moving towards, you're not going to be able to accurately assess that upside. So I think that's what you have to watch out for as an investor the most, and start, getting into the weeds of what's going on in the neighborhoods that you want to buy in. But that opportunity, once it's common sense, this is New York City, buyer competition has never been as low as it is right now. And chances are Shaun Riney might not swing the deal to you unless you're kind of been getting engaged. If you don't want to get swept up by all the big guys when the theory is that everything's going back up again, to buy in a bear psychology, you have to be prepared that it will go lower before it goes higher. You're never going to time the absolute bottom.
Yeah, it's totally true. What about, I feel a big distinction between, and that the ownership needs clarity between what's happening with coronavirus and the economic impacts. And this is a medical problem that will be solved by a medical solution, and then it'll go away. In many ways, it's accelerated and amplified some of the political difficulties that owners face, and that just the multifamily market in general face. How are you kind of distinguishing between the coronavirus's impact on value and that which would be more, this whole basket of politics and regulation and the future politics and regulation? How are you seeing that? How are you noticing investors see that? Because I think that's, my personal opinion is that's actually a much bigger impact on value, and it's a lot more difficult because it's so unpredictable.
The majority of sellers are lifestyle sellers. They're not necessarily in financial distress yet. There's some impairment to balance sheets, but they're more just lifestyle sellers that they want to do something different with their life because they've been tired of the politics for so long. I am an optimist. I think the silver lining here is things could get so bad. COVID puts a magnifying glass on the problems we were already heading towards. It takes a while to sink the Titanic, but I think we're saying Mayday, Mayday now, and it's kind of getting across. So look, the silver lining is things are getting so bad that the next mayoral election will be on a restoring New York City economy, platform, and that we really start to right these wrongs. But that remains the big, political X factor. And as far as these other trends of people going to the suburbs, I think that there's two camps. I don't buy it. I think, as soon as it's winter time and it's cold and dark everywhere, where else are you going to get laid? I mean, people are going to have to come back to the city. I mean, it's just going to happen, people. Like, this is just a short-term trend.
Yeah, it's funny. There was an article about that when they were talking about the spikes in coronavirus in other parts of the country, and that they all came from bars. And the article said, look, if you're between the ages of like 20 and 40 and going to bars, you're genetically programmed to try to socialize during those ages, right? That's the human race depends on that. So anyways, well, look, in this quick mini dive, Shaun, thank you. Dylan, thanks for your comments. And we'll talk to you guys real soon.